Can you hear me?
Okay, go ahead.
Good morning. Can you guys hear me? Can you hear me?
Can you guys hear? Okay, I turned the volume up.
Can you hear me now?
Okay. Can y'all hear? I can hear you, Mr. Scott.
Okay, excellent.
Yeah, they can hear.
Let me know when you're ready. You're ready. You're ready. Okay. We are now on the record at 9:31 a.m. Just let me know if you need to pause for stop the record. We continue.
Don, we can start, soon as you're ready.
Okay, can you guys hear me?
Yes.
Okay, good morning, everyone. It's my pleasure to call this meeting of the Sinking Fund Commission to order. Christopher, I'm going to ask you to outline the technical issues here.
Hang on 1 second, Don.
You got it.
I didn't hear what you said, sorry. Yeah.
Mr. Scott, did you say something? Just make sure I'm getting you.
Beg your pardon?
Okay. Speak a little louder and we're good to go.
Okay, Christopher, you need to make the report regarding the fact that this is a recorded meeting, or have you already done that?
No, I can do that now. Thanks, Don.
Thank you.
Just a reminder to folks, this is a public meeting of the Sinking Fund Commission conducted in the Pension Board's offices on the 16th floor of 2 Penn Center. The meeting is being recorded and a transcript and a video of the meeting will be made available on the Sinking Fund website in the coming days. As a reminder, by attending or participating in the meeting, by attending today. By attending or participating in such meeting, you consent to your video and audio being made publicly available. And with that, I will turn it back to Don.
Christopher, thank you very much. Sorry that we have to do it this way. But when you speak, if you could look towards that whatever is in front of you, I can hear you better. But the first order of business is the approval of the July 2025 Sinking Fund Commission transcript. Is there a motion to approve? A motion has been made and properly seconded, I believe. All those in favor say aye.
Motion passed.
All right, motion passed. Christopher, I'm going to turn it back over to you for introductions regarding the actuarial presentation.
Sure. Thanks again, Don. This morning we have representatives from Aon, PGW's actuarial firm should have copies of the most recent valuation report and a supplement on alternative funding schedules. And folks from Aon can walk through that report and answer questions the commissioners on that.
Thank you. My name is Elaine Sipper. I'm from Aon. I've been supporting the PGW account for about 8 years. I'm here with my colleague, Joe Hayes, who is also working on the account as well. As we walk through the report, if you have any questions, feel free to interrupt me at any time. But we'll start with the bound report, so the actuarial funding valuation report as of July 1, 2025. Any questions before we get started? Okay. The first few pages are just introductory pages. They lay out the contents of the report. This is the funding valuation report, not the accounting report. So strictly about developing the actuarial liability and the contribution for the upcoming year. If we jump to subpage 5, you'll see we have an executive summary prepared. This is just really high level of the plan's results as of July 1, 2025. So you'll see the plan's funded ratio increased from about 77.5 as of last year to about 79.6 this year. That's really due to 2 reasons. Assets performed above expectations, but there were some liability losses due to just demographic changes. And we also conducted an experience study earlier this year, which we'll get into more detail later. That drove the liability down up a little bit. So we were projecting the fund status to increase to about 79.7, and we came in at about 79.6. In the next paragraph, you'll see the active plan participants increased by a little under 1% from the last valuation. Or as of July 1, 2025, over the last year, the new participants that joined the plan, about 74% of them elected to join the pension plan, while the remaining 26% elected to join the defined contribution plan. And based on the active population, currently the employee contributions are about 2.5% of total payroll. Over time, we'll have retirees will have active move to retiree status, and eventually that will grow to about 6% of pay once all actives are in the contributory tier. Any questions? We'll get into more details on this as we go through the report.
One thing I just wanted to ask, looking back, I guess it was about 5 or 6 years ago, it was closer to a 50-50 split between folks who were entering the DC plan as opposed to defined benefit. That's been slowly rising into the 60s. Now we're at 75%. Is that being factored in going forward? That it seems to be a higher percentage of folks choosing defined benefit.
It is. We have projections of that for like the next 10 years, and that includes about 70% of participants coming into the pension plan, with the remaining 30% electing the defined contribution plan.
Okay, thank you.
Works. Any questions on the executive summary? If not, we can jump to the report page 1. And we have just a high level summary of how the plan demographics changed from the last year to this year. So active participants increased by about 7 participants. Retired participants increased by about 12 participants. And terminated vested participants, you had some participants move from vested status to retired status, so that went down by about 5. Pretty stable headcount, we increased by about 0.4%, so pretty steady increase. The total payroll for the active population increased about 4%. That's generally in line with what we expected it to increase at. You're looking at average pay of about $99,000 per active participant, with the active employee age decreasing slightly to 42.7 and the active employee service of about 12.5 years. Any questions there? Moving to page 2. So now we have the contribution development. So as a reminder, the PGW contribution, the funding policy is to contribute the greater of the 20-year open amortization or the 30-year closed. So we're showing all of that here. Another component of the contribution development is the normal cost. So the normal cost is the cost of ongoing accruals for the upcoming year for active participants. You'll see that increased by about almost 5% over the last year. I mentioned we did an experience study, so we adjusted retirement rates, termination rates, disability rates, and the conversion of time off in their final year. That increased their compensation in their final year, so we adjusted that assumption as well to be more in line with what we've actually seen happen. As a result, it increased the liability, and similarly, it decreased the normal cost as well. In the next section, we have the indicated mid-year contribution. So again, we'll show the 20-year amortization, the 20-year open amortization, the 30-year close, and then the directed contribution, which is what PGW has historically been contributing of about $30 million per year. When we're looking at the 20-year open, so you'll see that's about $24.1 million. That takes the unfunded liability, amortizes it over a fresh period of 20 years, and that's how we get that contribution amount. The 30-year contribution is a little bit higher. So under the current funding policy, the 30-year closed contribution will actually quote unquote win out in the sense that it's higher. So that's what the funding policy contribution would be indicated as. That's about $24.2 million. And again, you have the directed contribution of $30 million per year. In the next section, for reference purposes, we're just showing the contribution as a percentage of compensation. This is really just for your reference if you're curious and use this metric. The bottom section kind of just goes into how we expected the contribution to go year over year and how it actually performed. So last year, we projected the current year contribution to be about $23.5 million. You had really strong asset performance, which brought that down by about $1.4 million. But you also had demographic losses, which increased that contribution by about a little under $1 million. And the assumption changes, which increased it by another 1.3. That's why we're kind of differing from our projection last year of 23.5.
First, yeah, sorry, thanks. The finance director will be sending a letter next couple of days, confirming the $30 directed contribution for the next year.
So we'll remove potentially from this report when we finalize it.
That's right.
Perfect. Any questions on the contribution development? The next page is a summary of the liabilities. So we mentioned you had really strong asset performance over the last year. We had some liability losses. Overall, that resulted in an improvement in the unfunded. So you went from about $184 million unfunded on an actuarial basis to about $171 million. We're also showing the present value of accumulated vested benefits and the present value of accumulated total benefits here. We'll get into that in more detail on the next couple pages, but generally those liabilities increase due to the reasons that we mentioned, the assumption changes and the demographic changes. Section 2 on this page shows how the liability was developed. So last year, your liability was about $819.1 million. We expected that to grow with about $7.7 million of new accruals. Due to the passage of time, we expected that to increase another $55.7 million. We expected about $63 million in benefits to be paid out. And you're looking at an expected liability of about $819.6 million. So relatively consistent with what we had calculated last year. Again, you had demographic losses, so you had not more terminations, but differing termination experience than we expected. The ages that we expected were a little different than what actually happened. We also had more early retirements than expected, so that drove the liability up slightly. That's the reason that we did the experience study, to get the assumptions to be more in line with what we're actually seeing. So you'll see as a result of the changes in the assumptions, we're increasing the liability another $10.2 million. So that brings your current year liability to about $839 million. And again, the assumptions that we changed as part of that study were the retirement rates, the termination rates, the disability rates, and the compensation adjustment in the final year due to the conversion of time. So the number of participants that we expect to go from active status to disabled before hitting retirement. They're low. They're in the appendix. They're very, very low. They vary by age and gender. Any questions?
Repeat your question, please.
Disability rates.
Moving to page 4, we're showing how the assets have changed year over year. So we're showing both the market value of assets and the actuarial value of assets. So the information that we showed on the previous page with the unfunded actuarial liability, that's based on the actuarial value of assets. You'll see that's a little bit lower than your market value. So market value increased from about $655 million to about $703 million. That's what's actually in the trust as of July 1, 2025. The actuarial value, it defers gains and losses. So it kind of smooths out and allows that for less volatility. And as a result, you'll see that's a little bit lower at $668 million, give or take. That's because you have some gains that you're deferring into the future for the next 3 or 4 years. Any questions there? Moving to the next page. So this page is just a paragraphical summary of what we've already discussed in terms of the demographics. It just kind of outlines how the demographics have changed. So if we move to page 6, you'll see how the assets have performed over the last year. So you started about $655 million in the trust as of July 1, 2024. So PGW contributed about $30 million. There were about $3 million in employee contributions, and assets performed really well at $77.3 million. You paid out about $62 million in benefit payments and about $361,000 in expenses, resulting in a market value of assets of about $703 million as of July 1, 2025. if you jump to the bottom, you'll see the return that the market value rate of return was about 12.5% versus the assumed rate of 7%. The strong asset returns over the last year. Moving to the next page, so we mentioned the difference between the actuarial value of assets and the market value of assets. Here you'll really see the development of that. So you'll see the market value of assets as of July 1, 2024 was about $655 million. What we expect based on our expectations, the 7% return, we expected that to be about $670 million. Actual ended up being about $703 million. So you had a gain of about $32.5 million on your assets over the last year. The next section, you'll see how we're kind of deferring and phasing in those gains and losses over time. As a result, you're deferring some of those gains, and your actuarial value is actually a little bit lower than your market value, coming in around 95% of your market value. And for reference purposes,
5 years from now?
5 years smoothing. Yep,
Not 10.
correct. The actuarial value is what's used in the contribution calculation. So that's what's used in the unfunded liability that gets amortized for your funding policy contribution. Any questions? The next page really dives a little bit more detail into the results. So we went through the head count, that's line 1. Line 2 are the projected annual benefits. So based on your current retirees, you're expected to pay about $62.6 million in benefit payments a year. Your vested terminated group, about $3 million. And if your actives, based on our valuation assumptions, work to age 65, we expect that to be about $174 billion in benefit payments. The next line is your present value of projected benefits. So this includes future benefit accruals. So you're coming in around $975.5 million. That's based on your current population, but looking ahead as well, assuming they continue to work, continue to accrue service, and accrue benefits. You'll see the present value of those future accruals on the next line, line 4. That's about $136.5 million. Which means that your present value of accumulated benefits or your actuarial accrued liability is around $839 million as of July 1, 2025. We'll then compare this to the actuarial asset value of around $668 million, and that's how we get the unfunded of $171.1 million. Any questions so far?
We know what the average age is of retirement.
We do, it's in the appendix. Jumping ahead to page 18, yeah, around 72.4.
What's the average age of retirement? This is people in retirement. What's the average age of people retire?
Yeah, so we have an assumption for that, and it varies. We have different assumptions for each age.
Based on workplace experience.
It was around, I think we assumed 100% of participants retired at age 70. Yeah, if you jump to page 30, you'll see, so if they're already terminated and working elsewhere, and they haven't retired yet, we assume that 100% of participants will retire at age 65. If they continue working with PGW, we assume that 100% retirement at age 70.
So that's saying, we're assuming that by age 70.
Right. Yep.
What is the average age based on the experience at PGW that they might retire?
We can check that. We can double check that in the back.
Sure.
Yeah, absolutely.
Thank you.
Any other questions so far? And then lines 8 through 10 on page 8, we talked about it briefly. So you have your total normal cost, which encompasses the present value of future approvals, which we talked about that $8.2 million. You add the expected employee contributions to that, which is about $2.8 million, to get your total normal cost of about $11 million. Any questions before we get into kind of the details around the amortization components for the contributions? So we talked about PGW's funding policy being the greater of the 20-year open amortization and the 30-year close. This page shows how both kind of shake out. So the top section, you'll see the 20-year open amortization. The way we develop this is, in both cases, you'll start with the $8.2 million of normal cost. That is consistent among both scenarios. Under the 20-year open amortization, we take the unfunded amount of $171 million and we amortize that over 20 years. That means whatever the unfunded is next year, we take that amount and we amortize that over a new 20-year period. That results in an amortization component of about $15 million. Once you add that to the 8.2, you're at around $23.2 million. Take that to the middle of the year, that's about $24 million. We're also showing the contribution as of the end of the year for reference. Any questions on the 20-year open amortization component? The next component, again, we start with the $8 million in normal cost, but it's a 30-year closed amortization period. So that means each year we take any gains and losses that have arisen during the year and we amortize that over a new 30-year amortization schedule. That carries forward for the next 30 years. So you'll see back in 2015, we took the initial unfunded of about $195 million. We amortized that over 30 years. That's an annual payment of about $15 million, $14.8 million. Each year that amortization period goes down, but that payment remains in your contribution calculation. So the main difference is these, other than the number of years we're amortizing over, the prior amortizations continue to carry forward each year. That's the main drop. That's the main difference between the two. So as a result, we have this new loss of about $9 million over the year. I'm sorry, a new gain of about $9 million over the year, which is amortized. It added about $680,000 to that contribution amount. So that coupled with the $8 million normal cost, you're looking at about $23.4 million as your amortization component. Again, we bring that to the middle of the year, so you'll see that around $24.2 million. That is the greater of the two, and that's why you'll see that as the kind of indicated contribution outside of the $30 million for PGW for the upcoming year. Still below the $30 million directive, so I don't believe there are any concerns, but let me know if that is incorrect. The next page is just a graphical exhibit of that prior page. So you'll see in red is the amortization payment. You'll see on the right, it's just slightly higher, and that's what's causing that to win out. You'll see the normal cost in that dark gray, and then the interest bringing it to the middle of the year in the light gray.
23.8, would it be fair to characterize that as required in actuarial contribution?
Yes,
For example,
the 24.2. On page 9, the second to last, row 4.
so that would be similar for you.
Yes,
So it's a similarly new.
Right.
So you are above that would be 30, above that is additional contribution.
yeah, it's all discretionary, and that only helps you kind of improve your funded status, which we'll see in the next couple pages. Yep. Moving to page 11, so this is the actuarial present value of accumulated benefits. This is under what we call ASC Topic 960. It's really for plan reporting purposes. It just gives additional detail on your vested benefits versus your non-vested benefits. Another kind of difference here is it's compared against your market value assets, not your actuarial value of assets. So you'll see as of July 1, 2025, you have about $761 million in total vested benefits. You have an additional almost $24 million in non-vested benefits. So these are people who haven't reached full vesting status yet, but are still kind of accruing benefits, for a total present value of about $785 million. This is then compared to what was actually in the trust of about $703 million for an unfunded of about $82.4 million. And then just for reference at the bottom, line 6 here, you'll see about 70% of your active population is fully vested. So you still have about 30% that is not fully vested yet. And that 30% is what's contributing to that $23.8 million above. Moving to page 12, this is the next 10 years of how we expect kind of the benefit payments to shake out. So this first column is what we expect in benefit payments for the plan participants. The middle column is the expected contribution. So this is based on the funding policy, not the $30 million directive. So this is just based on the greater of the 20-year open and the 30-year closed amortization contribution. It's also offset by your expected employee contributions. So once you have your benefits paid out, you're putting your contributions in both from the employer and the employee. You'll see the expected benefits that are actually expected to be paid out of plan assets in that rightmost column.
Gee. That you want more benefits, so say. This page you're saying city reports and not, so what's the difference?
So the difference is this is not this on page 8, line 2. That does not take into consideration how we're expecting the retirees to move over the next year. So we're expecting some mortality there. We're expecting some terminated vested and some actives to kind of come into that population that you're seeing on page 12. Page 12 shows how we actually expect participants to move throughout the year. And as a result, that's the number of benefit payments we would expect to be made. On page 8, this is just if you were to take all of your retirees and sum up their benefits, that's that number. Okay. Any other questions?
And sorry, fair to say they're going to be contributing 30 million. Then obviously that expected benefits paid from assets will drop down by that extra 6.
Yep.
It's more in line with the 31 million or so that they've been.
Right. And then we're also expecting 7% asset return as well. So that doesn't necessarily mean that we're projecting the assets to decline by that 37 million. That's just the net inflows and outflows that we're expecting based on the funding policy.
The problem solvers.
Any other questions here? Okay. Moving to page 13. So this is really just a historical summary of the funding status over the last 9 years. You'll see we have a table at the top and a graph on the bottom. The graph on the bottom, we have both market value, we have both asset value basis. So you'll see the accrued liability in the gray or bluish bars, and then you'll see how the funded status has changed over the last 9 years. So in that black line, you'll see that's based on the assets moving. You'll see it's a little bit more consistent, it's less volatile because we're moving in gains and losses over 5 years. When you look at the blue line, the market value, you'll see big changes in the market kind of impact that funded status. So you'll see from 2019 to 2020, that increase slightly, but then you'll see that spike up in 2021 and then that drop down in 2022. So using the actuarial value of assets allows you just to kind of smooth those in. It allows the contributions to be a little less volatile as well. Moving to page 14, this is just the backup for the funding policy contribution over the last 9 years. You'll see there was more volatility in the 20-year open than in the 30-year closed. And that was really as a result of the funded status improving. The indicated contribution should generally decrease, and that's why you're seeing that kind of come down a little bit. Your 30-year has been slightly less volatile. That's really due to the longer amortization period and the carryover of prior amortizations. But again, this is all historical. This is back up to how we came up with the greater of the 20-year open and the 30-year closed contribution schedule. If we move to page 15, again, this is just a graphical exhibit of that prior page. It shows how historically you've seen the 20-year open amortization kind of be greater. That is actually switching in 2025 and beyond. Now we're expecting the 30-year closed amortization contribution to, when I say win out, it's greater than the 20-year closed. Any questions so far? That was all historical information. Moving to page 16, now we're looking at the next 10 years. So how do we expect the contribution and the funded status to play out over the next 10 years? Again, this is based on just the funding policy. So the greater of the 20-year open, 30-year closed. Again, the 30-year closed is what's winning here. So you'll see that contribution kind of flow through. And as a result, as long as you're continuing to make at least the minimum required contribution, that increases steadily over the next 10 years.
Sure. These projections not assuming they're.
Right. And now's probably a good time. I gave another handout. The last page of this handout shows how we expect the funded status to move under a $30 million contribution over the next 10 years, consistently year over year. So on this last page, page 4, you'll see based on this cost method and the actuarial value of assets, we're projecting over the next 10 years this plan to reach a fully funded status based on the $30 million contribution. Is that helpful? That is okay.
Because it shows the difference. What would also be nice. Some estimates from finance director to be a chart showing both. Showing this the $30 million, assuming 30 million, which is this one, and then the city one, just both on the same graph.
Yeah.
Just a quick comparison.
Yeah. We'll add that. We'll add another page to the supplemental report. That was really why we brought that supplemental report. The other pages in there, the first page is exactly what we're seeing on page 16 of the report. The next 2 pages are just the backup to that. The page 2 is the 20-year open, just looking at that in isolation. The following page is the 30-year close, looking at that in isolation, and then that last page is the $30 million a year. Any other questions on the forward-looking funded status and contributions? Page 17. This is the low default risk obligation measure. We call that the LD-ROM. This is a relatively new actuarial requirement that we're required to give you. We have to measure the liability on a interest rate basis that's consistent with low default risk fixed income securities. As a result, you'll see the discount rate comes down from 7% to about 5.54%. And similarly, your liability jumps up to about $984 million.
This is a serious question. Maybe it's worth investment. So with current status of the bond market, risk associated, increased risk associated with bonds due to the interference with the Fed and other things. Curious as to what happens to this as risk free, so to speak. I mean, this may tend to have less relevance going forward if some of these policies continue.
Potentially, I think, take your point, right, and I think that could be a rewriting of some of that out, that might risk and risk-free rates. And, yeah, that's the greatest thing.
Big thing.
Yes, absolutely, absolutely.
For reference, you don't have to do anything with this measure. We're just required to give it to you. Any questions so far? So that's really the bulk of the results. The next couple pages get into the demographics as of July 1, 2025, and the assumptions that we use with evaluation. We're happy to go through that, but that really summarizes the evaluation results as of July 1, 2025.
The actual average age, 72.39 years.
That's the
That's the retirees.
Yeah.
The people here now. This is kind of follow the question you were just asking, Frank. Does it make sense for Aon to put, given that it's going to be 30 million a year, to put that in the actual final report at the page or two, as opposed to, yeah. So the third, so I would, in addition to what Fran asked for on behalf of the finance director, I think this page 4 should also be in the actual fund report, since that's what we're going to do.
Okay, do you also want that additional page in the main report and the supplemental report?
Yeah.
Yeah, no problem. Any other questions on the 2025 evaluation? I mentioned that, we did adjust some of the assumptions. They're in the appendix. We adjusted the retirement rates, donation, disability, and that final year compensation adjustment for time off conversion. Anything else?
Don, any other questions?
I really couldn't hear everything that was being said, but when you project forward, do you have to make any assumptions relative to AI and the impact that is likely to have on your employee base?
The actuaries.
Yeah, that's probably a question we could follow up, Don, either at the next meeting or intro meeting after speaking to Joe and Dan, the folks down at PPW.
Okay.
And I can see. Go ahead, sorry. I was just gonna say, I could see if we have anything specific to like the utility industry at Aon, on how we expect that to change anything.
Thank you.
That's all. Here.
Thank you.
Thank you. You want us to stay?
It's up to you.
Okay.
Either. So Don, we could move to the third agenda item. The investment performance and review. She will primarily concentrate on the August report as it's the most recent. The only thing I wanted to mention before Quago and Lee go through numbers as well as brief updates on Copeland and Pine Bridge. The total assets in the plan this morning were just under 730 million, 729.96. And that includes about $12.6 million in the cash account. I have been having some discussions with Marquette about raising a little bit of additional cash given the heightened state of the equity markets. If we did that, it would almost certainly come from the Russell 1000 domestic large cap assets. With that, I don't know which you want to start with.
Wait, here's an issue. Take through the market environment, then I'll take through the performance. And a bit of attribution of COVID.
Yeah, I'll start with the executive summary. And you guys don't have this, but every day we trade updates stuff regarding the markets. And through yesterday's close of business, just wanted to give you a sense of how the markets are moving. So as we talk about August performance, the state of the world, like a month's difference, like wait till like a year's worth of headlines and so on. We just wanted to give you a sense of how the markets are moving through yesterday's close of business. So broadly speaking, the markets are up, so fixed income is up, with the prospect of rates potentially coming down. The US equity market continues to have a pretty strong year, but the US equity market has lagged the non-US market pretty materially. So the US market is upward 2-3% from where we were at the end of August. And then the international markets are up around 3% from where we were at the end of August. So that's just a quick flash update on where the markets are moving. With the executive summary, I'll pull out specific pages just to be mindful of time. But if there's anything you'd like us to go through, we'd happily jump into that. So on page 3, we have what's in the periodic table. And on this periodic table, very quickly, what's at the top represents the best performing asset class. What's at the bottom represents the least performing asset class. As you can see, 2025 year to date, the international small cap segment of the market continues to outperform pretty meaningfully. And with the international markets, they've seen 2 pretty strong tailwinds that have led to the relative outperformance. Those tailwinds can directly be attributed to, I guess, US policy. So when we think about the beginning of this year, when we think about Liberation Day, tariffs, and the knock-on effect of tariffs, one of the knock-on effects of tariffs was a depreciation of the dollar. So the dollar depreciating has essentially been a strong tailwind for the international markets. We'll mention that and what that's meant from a return standpoint of tariff. The other thing that's been a pretty strong tailwind for the international markets has been, I guess, the resetting of the international world order pretty much overnight following the new administration coming in. So the post-World War II structure of order and law really was led by the US, right? We weren't really isolationist when you think about the US's involvement in global policy. We then had the Zelensky in the White House, which really just alerted the rest of the world to the fact that you can't necessarily rely on the US to come in and be the backstop in the event of a big international crisis. So we've seen a lot of reinvestment in militaristic infrastructure from overseas. So your Germany's, your France's, Italy's, and so on, and now bolstering up their spending. So that's helped drive the international markets as well. Turning to the next page, page 4, the executive summary, we see here for the year-to-date period, all of the major indices are on the right-hand side, showing that they are performing collectively. So that's a really good picture to take a look at. But as we dig a little bit deeper, we will see some dispersion across the various segments. So we begin at the middle of the page, once again, with international. And with international, if we look at the EFI and then the EFI local, just as a quick comparison, year to date on the right-hand side, the EFI local, which is in foreign currency terms, returned 11.6%. You then translate that to US dollars, that gets you to 22.8%. So again, a depreciation of the dollar has been a pretty meaningful tailwind when you think about relative strengthening of foreign currency relative to the dollar. The other thing, that 2025 has been marked by is a lot of volatility. So if we think about the relative performance of growth gathering or in other environments, we've seen growth steadily outperform, just consistently, even if there's a small retreat in the valuation of growth, growth is typically done a lot better. In 2025, we've seen this interesting dynamic where growth does exceptionally well, but then during a sell-off, growth is also caught up on the chain quite a bit. So if you look at the difference between core value and growth, it's not as meaningful as what we've been used to seeing, right? So your large cap or the Russell 1000 is up 10%, 10.8%, I should say. Your value is up 10%, and then your large book is up 11.3%. So less of a delta we've been used to seeing. Fixed income is a positive territory, still in the low single digits, still positive, and the prospect of interest rates coming down is really priced in, viewed as a positive by the market. So that's the quick snapshot of where the markets are moving across the major asset classes. What I'll do here is point to a couple of exhibits that support the notion of interest rate potentially coming down as soon as today. So when interest rates were elevated back in 2022, this was really to combat inflation from stimulus. Stimulus took place during COVID to really stave off the Great Depression, and that stimulus had an inflationary impact. If you think about more money in the system chasing fewer goods, particularly in the event of a supply chain disruption, the knock-on effect of that was greater inflation. The Fed has kept interest rates elevated to make sure that we don't get in a position where rates come down, spending goes up, and then there's more inflation in the system. So that's where interest rates have been a little bit more stubborn in recent periods. But if we think about some of the indicators that the Fed's looking at, some of the movements in the economy that would point to rates potentially going down, you can think about the labor market. More people that are working, less people that are working gives you an indication of what inflation may look like and the state of the economy. So the labor market, we'll see here that the job growth number was less than expected in the month of August. More fragility when we think about job numbers, unemployment going in, and then revisions of additions to the labor force to the tune of around 1 million. Negative, I should say, all of this is boded pretty well for those in the camp that would rates potentially coming down. When we jump to page 11. Yes.
Did you say?
Interest rates don't get.
Thank you.
No problem. I was trying to remember what I said. Challenge.
Was Reddit talking now?
So as we think about page 11, another key indicator would be manufacturing. And as we think again about tariffs and the trade war and so on, I mean, one of the direct knock-on effects has been the uncertainty, right? So as creatures, human beings, we like certainty. Businesses like certainty. They like to plan out. They like to buy goods, materials in anticipation of certain amounts of demand. But as we can see here, this environment of uncertainty caused by tariffs has led to more volatility in manufacturing. You can see here that U.S. manufacturing has faced a slump as a direct result of the trade policy that we currently have. So that again bodes pretty well when you think about rate cuts. It's a weird thing we don't necessarily want to predict. Rate cuts are a good thing, but the reasons for the rate cuts are a very tough thing to kind of look for when you think about the economy slowing, employment levels not being as robust. So it's definitely a bittersweet thing. You think about rates and reasons for rates potentially coming down. Page 12 takes us to rate expectations, and this number has moved quite a bit throughout the year. So at the beginning of the year, we were looking at potentially 4 cuts right at the beginning of the year. All of a sudden, going towards the end of the first quarter, it did appear that rates would be coming down. The number now goes between 2. We're already at this point, we're in September, so it's gone between 2 and 3 rate cuts between this point in time at the end of the year. So that's pretty much where we're at when we think about 2025. It doesn't appear that rates will finally come down. However, the magnitude of the rate cuts, I think that's up for debate. Just given the fact that the market is this very, very delicate place. Too aggressive with the rate cuts, it can be counterproductive when the market sells off. Too benign with the rate cuts, it doesn't stave off the slowdown that it appears we're heading towards. So again, really don't envy the Fed and the position that they're in. So on page 14, we'll jump into performance for fixed income. When we think about the fixed income exposures we have in the same fund, it's pretty diversified. We have some high yield, quality high yield, bit of an oxymoron, so, but we have some quality high yield in the portfolio. We have some intermediate fixed income and some aggregate fixed income in the portfolio. And you can see across the board, the fixed income exposures would have been positive contributors to returns, and the notion of rates coming down, that was a nice driver for the asset class. If we fast forward a little bit to other areas of the portfolio, page 26, this takes us to U.S. equities. We've once again seen U.S. equities holding up pretty well. Year to date, up 10.8% in the S&P 500, value up 10%, growth up 11.3%. We can see a little breakaway with mid cap, particularly on the growth side, is doing pretty well. We can also see on the small cap side, the more and growth holding up well. Value also up pretty nicely at 6.9. If we go further out to the left-hand side, you can get a sense of just how much volatility that's been. So if we look at the Russell 2000 value as an example, for the 3 months ending August, that was a 10.4% result. Year to date, 6.9. So it just gives you a sense of how negative certain parts of the market were until we saw this pretty nice robust rally. Now with small caps, they're also in this very delicate place where small caps are very sensitive to interest rates. So the notion of rates going down would be a tailwind for small caps, but the notion of the economy being a delicate place would be a headwind to small caps. So we continue to look at small caps as an area of volatility. And I would say that active management, particularly on the quality side, we would expect that to hold up pretty well as we continue to see more macro developments with the towards an average environment. Jumping ahead to page 27, one of the things we see in the US market is more of an even distribution of returns. So this time last year, we definitely saw more of a lopsided picture where anything that was growth, leading, anything that was technology, communications, that ended up being significant returns. In 2025, we're definitely seeing more of a distribution across the various sectors. So it's not just a technology-driven economy, but with that being said, technology continues to, I think, carry the day. Think about what's been really supporting the US market. The next page takes us to factor performance. When we think about factors, what are we talking about? We're talking about large, small, medium, we're talking about quality, we're talking about value, growth. But we can see here that factors are also moving when you think about the types of stocks being rewarded. There have been periods in 2025 where growth has done exceptionally well, and there have been periods in 2025 where quality has done exceptionally well. And what we're seeing right now with more uncertainty in the marketplace is that trend towards value or quality holding up pretty well. And then we're also seeing your larger cap names also hold up pretty well. So we continue to think in this volatile environment, there will be more of a leaning towards the quality, probably a little bit more of a bias towards large cap, just given how large cap companies are typically in a better position to weather a cycle in comparison to, let's say, your small cap and your mid cap. Page 28, the AI story. So AI, when we think about the value chain, there is the spillover effect where other segments of the market can benefit. Real estate's holding up pretty well. And real estate, for example, the storage component or the industrial component of real estate is poised to do pretty well when we think about the AI story. So AI continues to be, the dominant driver of where the U.S. economy is going. And it's this weird thing, once again, where you think about the quote unquote efficiencies that will be created from AI, particularly when you think about the labor force. But then you think about the spending and the supply chain and also benefits from AI. So that in itself create more volatility in the market, more volatility in the market. We would expect, again, more gravitation towards quality names, fundamental types of stocks, and companies that are actually learning something. So the days of, I'm going to say this, 2026 is going to be all about the beam stuff, but you would expect at this point investors to really be more discerning, to think about, okay, is there income coming from this company? Are they actually making commitments? Or is this just us bidding up the cost of a stock that looks really good and it's been talked up? Expect more normalcy in the markets, but again, 2025 continues to tell us that normalcy is this thing that you dream about, but we'll continue to see where the market goes. So page 30 takes us to where the market could potentially start favoring stocks and the types of stocks that would be favored. So we have the so-called meme stocks, which again, you think about Robinhood, Reddit, the types of stocks that just catch fire. You think about GameStop as an example. GameStop just went through a phenomenal during COVID, and then certain stocks like Procter & Gamble's, Johnson & Johnson is actually doing something, actually earning money, people are buying those goods. So pretty unclear that lagging these so-called meme stocks. So we would expect it's to come down. Will value stocks to be up. So why that? Will value stocks to pay higher dividends than stocks. So in a lower interest rate environment, the value of stock that's paying dividends would be that much more, right? It should collect more of a premium. And then with the economy potentially slowing, you can also expect stocks that can navigate the economic cycle a lot more strongly to hold up pretty well. So with our portfolio, think about the positions we've got on the international side. We have Acadian, Venus Partners, Pine Bridge. We have on the domestic side, Copeland that we talked about. There's more of an intentional quality bent to the portfolio. So as we're going into this point in the cycle, would expect our active managers to hold up pretty well for us, given the quality bend and everything just mentioned here. And then we would expect if there is noise that really leads to more volatility on the indexing side, we'd expect the active managers to essentially hold up for us. If the reverse is true, we'd expect the indexes to essentially compensate and the active managers in that thesis hasn't come to play. So with that, I would really just for the international markets on page 32. And on page 32, once again, the international markets, a little bit of erosion. But the majority of it, again, has been really from US policy in 2025. You can see here that the non-US market is comfortably outpacing the US market. The ET index is more than doubled its large counterpart. Emerging markets close to 20% year to date, and then the small cap side of things about 26.4%. So international markets have completely dominated in 2025, and then discussion going into 2026 will be, where is foreign policy from a U.S. standpoint? Will that be being reversed from a U.S. standpoint, or are we beginning to see a little bit of a reset when we think about the global economic trade? And ultimately the dominance of the dollar. This isn't a new discussion. I want to say since the 1980s, had this conversation about is the dollar down the count, and up until this point, it was really weighed in favor of the dollar. At this point, we'll continue to monitor, see where things go, what concessions are given from the White House, and then have discussions around the asset allocation. But with that, I'll turn it to Lee, unless there are any specific questions regarding the market environment, any slides in the executive summary that we can go through.
Thanks, Maybe. Do you mind following up the August report? On taking the page 4. Good morning, everybody. You go to the August report. Okay. Okay. So I'm going to take you through 5 pages of the audit, and then we'll finish up with just a few minutes. Going to go a little deeper on kind of relative performance this year. So if you see on page 4 there, you know, good news, as you can see over recent years, is the fund has grown a lot, made a lot of money. Typically that 5-year number there, 9.4, well above your risk rate of return, which is why you've seen your funding really improve over recent years. Now, if you look at more recent performance of the 1 year and year to date, you can see your fund has lagged a little to the benchmark. And really, from what Blake just told you, there's really 2 things going on this year. The first half of the year, again, was post the sort of pullback on tariffs in the second week of April. The market sort of took off again and kind of mimicked what we saw last year, with the Mag 7 really leading the way in mega cap. So you saw in the first half of the year, small caps did lag a fair amount. So a bit of that underweight is having some slight overweight for small cap within the portfolio. Fortunately, because of all your indexes in the large cap space, you're not really underweight the Mag 7, so you've been able to keep up with the market from that point of view. But being overweight a little of small cap, a little bit of a headwind earlier in the year, and the other story this year, all under the Mag 7, a new term I'm going to throw out there, is the unprofitable 858. And out of the Russell 3000 index, you know, just a little under a third of the stocks, and then primarily the smaller stocks, are actually unprofitable. And they're the ones that took off in the second week of April, really contributed to returns. So having a bit of more of a quality bias in your portfolio is why you're slightly behind your day. Now, more recently, you can see through, obviously, if you look at the fiscal year, 1 month, you can see that's close to what the market's grown and small caps have outperformed large caps over recent months. And that combined with some rebalancing that you've been doing, as you can see on the bottom left there, you pretty much ended them up right on target because you've been trimming some of these winnings that you've seen out of international, over the past quarter. So that is why your performance more recently is back right on track around bench, and just slightly ahead of the benchmark. You jump a couple of pages, page 7, just look at your market value. Good to see here you've had this steady 31 million or so going out a year. What with your the combination of employee and employer contribution, sort of slightly above that. So it's great that actually, but from that point of view, contributions are keeping up with the money going out of the plan to pay benefits. And that's about 4.5% of the asset value within the portfolio. So you can see you performed quite a bit better than that, while you've seen the fund at the end of April just around 720 million. And as Chris stated earlier this morning, we're above that again as we sit here today. And then let's just finish up on some of the individual managers. Go on the next page, which is page 8. So we've already got the total fund, but if we look at fixed income here, we look at the composite to start with. Obviously, year to date, quite a bit ahead. You do have obviously a little bit more credit within your fixed income here. Not unusual. Most funds do. Sort of how net of fees, fixed income deposits can sort of outperform the ag longer term. But you can see that delta of that performance is coming in somewhat now more recently, and that is because spreads are becoming so tight that we've seen now. And so a lot of your managers, or plus managers, etc., don't have a lot in the plus sectors right at this moment in time. So if you look at Barksdale, that is sort of your most conservative fixed income manager, never going to be too far off the bench, as you see going back now. And as I said, with spreads tight, they've actually repositioned their portfolio, almost looking like the ag at this point. You have a lot more in treasuries. Again, with this sort of fear going forward, and maybe potentially slower growth, and more stress in the market going into 2026. Medline, that's Core Plus, the one below that, fixed income. Again, being able to dial into the plus sectors of sub-investment grade is obviously been accretive over the ag bond for them longer term. But again, as you can see more recently over the past month, spreads are getting so tight they don't have much in the plus sectors at the moment. So again, expect a little bit more benchmark type performance from there for the rest of the year. The investment grade credit, predominantly all investment grade, but it is at the lower end of actually the average credit quality there is triple B. That has obviously been very accretive to the portfolio so far this year. We've had this low quality rally, per se. But I think as you come into September here now, you're actually seeing high yield actually fall behind all bond from a return point of view. So going forward, there'll be probably a little bit more pressure on the credit side of things with the fixed income markets. Then Garcia Hamilton, they have now transitioned to the ag benchmark, and you see their performance, at least if you look back over time, sort of mimics that quite, more close to have quite a bit in mortgages. And that sort of longer duration that they had in their portfolio, which is sort of why you moved to the ag. It's obviously been accretive as rates have come down this year. You see them posting 6.2 relative to the bench, just over 5. And then finally, your last manager there, Pew Capital, Waco alluded to a little earlier. They tend to be a little more the higher quality end. Not a lot in the triple C area, the real junk area. As you said earlier, being in that real junk area is what's contributed to high yield manager returns this year. That's why you see that year to date of 5.5. They have lagged the bench, as you would expect. It's a little bit higher quality. But you can see more recently, as I said, we've spread really tight here, and the fear of maybe a worsening economy. That's actually working for them because they have less of that lower end there, the triple C. I'm going to jump you forward 2 pages to cover international first, so we can finish on the domestic. It's just quickly here, you got that mix of 2 active and one passive manager. It's worked exceptionally well for you over the years. Seeing considerable outperformance there. You have more active strategies in the international markets just because there's more ability to add return with the index, by rotating not only in and out sort of stocks and sectors, but countries and currencies. Gives the managers greater ability to add some returns for you. And then obviously this year, from a relative point of view to the US, with the dollar depreciating over 10%, that's really been a shot in the arm for international returns too. Canadian here, obviously great longer term performance. They started to struggle a little bit over the summer here. The good news is because they had greater performance in the first part of the year, that's where you rebalance out of it. So taking that 7 or so million out of the Canadian, every now and again you get lucky on the timing point of view. But it's just good housekeeping on trimming them. You seem to trim them at the right time here. And then Earnings Partners, that's the MWBE manager. Again, great longer term performance. And nice to see, over the 1 year, I've liked the Canadian somewhat. But now when the Canadian's not doing as well, Earnings Partners is actually outperforming by handling. So when you look at it all together from a composite point of view, a little lag over the summer here, but not too far behind the bench, and great absolute returns. And then if we finish up on page 9, we'll just give you domestic equities here. So for the most part, you can see, if you look at just the composite line at the top there, you can see you do have a lag just to the broad for some 3,000. Really 2 areas there. One is just having a little bit more overweight to small cap, which again is not unusual for a pension fund longer term. That tends to pay for you. And as you see that 1 month number there is small cap starting to do a lot better now. you can see quite a bit ahead on that aspect. And then the other part is just the higher quality that you have with that Codebill strategy, which I'll come to here shortly. Online and open trust are just mimicking the index of low cost, and that's sort of what you're seeing. If you actually look at that from a ranking point of view, it's about top quartile going back the last few years. It's been very, very difficult for any active managers to outperform large cap benchmarks, so just because of the way the bank sells. And if you look at PineBridge, that's more of an enhanced index approach. Not unusual. They tend to lean down more to the mid cap space, try and get a bit of alpha. That's what you tend to see with enhanced indexes. So that's sort of why they've seen a little bit of a lag for year to date, 1 year, why you're seeing better performance now against small caps that are doing much better. And then just a quick update on PineBridge. You remember in December of last year, there was a press release from them that they were selling their asset management business to MetLife. That deal is still scheduled to transact this year. We've been following through regular calls with them. The assets are still there in place. No one's been taking money from them. And performance is still been coming in as we would expect. So, and this thing set now, still very comfortable what they're doing for you. And then finally, on the small cap side, if you look at Copeland, and obviously recently over the past year or so, having this higher quality bias when it's really been the unprofitable companies are running. In the small cap space, 43% the Russell 2000 companies are unprofitable. So Copeland won't buy them; they're completely out of the index. So that's been sort of a lag this year. But when you look at the performance, as I say, within that small cap space, you see far better returns. But at this point in time, we haven't seen a sort of reversion into quality yet. You know, we'll see what happens with the Fed meeting today. But I think you're going to see a little bit better performance of that. We do see more of a stressed, weaker economy moving forward. And that sort of would lead me into this. I don't know whether you're able to pull it up. I have brought with me some copies here that I'll just pass around in case you don't have them. Sorry. Just a few pages I brought out. Chris had mentioned weeks ago when we sent this report out. Maybe it'd be a good idea to just give you a little bit of colour. I know it's a question I've been asked in the past. But Copeland, when do you expect them to lack? Do you expect them to sort of lack? So just quickly here for them on page 2. And this data I'm going to show you from an attribution point of view is through Q2 25. Why that date? That's what I've got the attribution data for. I don't have it for August as of yet. But a couple of things to note here, as we said earlier. There are three in number you can see is like that blended benchmark is actually the benchmark. It's Russell 2000 until July 1st, and it became the 25. So you have lagged over the past 3 years by about 100 basis points. Most of that has really been driven by this past year. As I said, the first half of the year, we see actually slightly negative relative to the bench 7.7. I've added this index called the Small Cap 600 Index, the S&P, and what that does, those indices, they have a quality screen on them, so it takes out the unprofitable names. And when you actually look at the performance, then you can see actually the performance this year is actually been more in line year to date with that type of strategy, that sort of higher quality strategy. Again. And you see this with these sort of dividend growth type portfolios, all up and down the market cap. They will have higher tracking error to these Russell indices. You know, when they're in favour, they're going to post returns well above. When they're out of favour, like recent years, their performance will lag somewhat. If you look at that 5-year number for them, 11.1 relative to 10, even with all the recent underperformance, still ahead over 5 years because of what they did for you in 2022. So when you have that environment where you do see a sell-off in equity markets, they tend to hold it a lot better. I think they were only down 12% in 2022 when the index was down 20. So not being as down in those markets, i.e. not digging as big a hole on the downside, when it does recover, you know, you have a higher asset value, and the market recovers quicker. And that is the old philosophy, particularly when you only have a 2 asset portfolio of stocks and bonds that have some quality, particularly in the most volatile area, small cap area. I think makes a lot of sense for it to find benefit. Just quickly on the next few pages here, just again show you the difference between unprofitable and profitable, you know, companies this year. You can see in the blue there, that these are the top returning stocks. On the left are in the 2000, on the right in the 2500. The blue highlighted ones are the only names that actually make money. Everything else, see that top one there? Aviva Technologies up over 400% in the second quarter. Does it make money? Really not been up that much. It's crazy. If you look at that note at the bottom, the top 25 performing stocks are up over 200%, and less than a third of them actually made. But that's sort of momentum with me thinking what's going on about. You turn to the next page, we look at some sort of quality metrics. Which you can see in that second quarter there, if you actually did make money and positive earnings, your performance was around 7%. You didn't make money, the average was about 17, about 10% difference there. But ultimately, we'll be taught in school and everything, long-term earnings drive where stock prices go. So we've been pushed and tested on that a little bit the last couple of years. With the Mag 7 run, etc. But ultimately, longer term earnings will drive where stock prices go. And then just a couple more ones to show you on page 5. Another sort of quality measure, return on invested capital. That sort of measures how effectively a company generates profits from, you know, capital invested on behalf of the shareholders. You know, how much value can it create? You look at the lowest 20%. They've done a poor job from that point of view, then it starts from 17%. Did a good job, the highest quintile there, you're again only up 7. So that's sort of 10% difference again. And then one final one for you, we just want dividend growers, because that is really what opened the focus on as they build this portfolio. You know, what they're looking at is for consistent increasing, and companies are increasing dividends. And that normally indicates financially stable, well-managed, profitable business. Should pay long term. Again, quarter 2, those type of names are only at 3.5%, the non-payers at 14.6%. So what does it all mean? Last page for you. Obviously, as we sit here today, you look at the discount of dividend growing stocks, you can see they're at about 20% below the sort of long-term average because of just the way the unprofitable companies have gone up. And to say, we started to see it in the performance on the first page where you showed you in September here, where say the more riskier assets are not doing as well. So, you know, who knows what Fed are going to do today. But I think if you know, if we start to see rates coming down, that's obviously a good shot in the arm and a tailwind as well for dividend paying time stocks. So, you know, I think just to understand their sort of relative performance, I think it's important that this trustees on a fund, and you know, although we never want to see that on the performance we sort of saw this year, it's sort of explainable just on the way they put that portfolio together. But even with that most recent underperformance, you see longer term having that sort of quality bias in that area actually work for me. Any questions on any of that? Okay. Thank you. The other announcement would be that the next meeting is scheduled at 9:30 a.m. Wednesday, February 12th.
Don, I don't know if you had anything else, Chris, Nate, Grant, Bill, but otherwise that would be the entirety of the agenda. So,
No, I don't have anything else. I guess it's time for this meeting to adjourn. Is there a motion to adjourn?
you have a motion and a second, Don.
All right. Have a good day.
Thanks, everybody. Thank you.
All right.